Question 25. Jack's recording studio purchased $8,400 in electronic components from Music World. Jack signed a 60-day, 6% promissory note for $8,400. Music World's journal entry to record the sale transaction would be as follows. Music World on their books would debit notes receivable for $8,400 and they would credit sales for $8,400. Number 26. Uniform Supply accepted a $18,000 90-day 8% note from Tracy Janitorial on October the 17th. What entry should Uniform Supply make on January the 15th of the next year when the note is paid? So that would be the full 90-day time period from October 17th to January 15th. Assuming, you should also assume that December 31st is a fiscal year end. Now, when that's said like this, what that means is that the company made adjusting entries to accrue interest that had been earned but had not been paid and won't be paid until the note is due. So, on January the 15th, here's what we're looking at. We're going to get a sum of money that's equal to $18,360, and here's what this is made up of. First of all, it's going to be the principal of the note, which is $18,000. It's also going to be the interest that we have accrued from, from October the 17th to the end of the year, December 31st, which would be 18,000 times 8% times 75 days. There's 75 days from the 17th to the 31st. Over 360, which would be $300. So from the time this note was written to the end of the year, that company owes us $300. So we're also going to collect that. And then from the December 31st or January 1st until the note is paid, which is the 15th, so there's 15 days from that end of the year until the note is being paid. Those 15 days are also going to be interest. And that'll be 18,000 times 8% times 15 over 360, which is 60 days. And we're going to get this also. Now, the way you record this, we get all of these pieces, and we're going to get a total of 18,360, and we're going to debit cash for 18,360. We're going to credit interest revenue for the current interest that we've received, or that we've earned on from January the 1st to January 15th. We're also going to credit interest receivable for $300 because this takes the interest that they owed us from the 17th of October to the December 31st time period that we have accrued, and now we're going to get rid of that accrual and get rid of that interest receivable, $300, and we're also going to get rid of or take off the books the note receivable for the principal. So all three of those pieces, this year's interest, last year's interest, and the principal will all be given to us in a sum of cash for $18,360. Number 27. Uniform Supply accepted a $6,200 90-day 12% note from Tracy Janitorial on October 17th. The note is dishonored. That is, Tracy couldn't or didn't, whatever, pay us. What entry should Uniform Supply make on January 15th of the next year? Well, it's very similar. This entry and this entry are very similar except for one thing. Here they paid us, here they didn't pay us. And when they don't pay us, of course the amounts are different here. So we're going to get rid of the notes receivable, $6,200, because that note is due. It's come due now. Even though it hadn't been paid, it's been dishonored. We still have to get it off our books. So we're going to credit that for $6,200. We also are going to show that the interest that we accrued from this October 17th to the end of the year on December 31st, that interest that we'd set up at December 31st as an accrual entry, that interest needs to be credited, okay? And the interest that we've earned from January the 1st to January 15th, that also is going to be shown as interest revenue. Now, all three of those pieces, this year's interest, last year's interest, and the principal of the note, all three of these pieces are going to be set up as a debit instead of cash because they didn't pay us. It's going to be set up as a debit to accounts receivable. They owe us this now, and the note, like I said, the note comes off the books and now it goes back to an accounts receivable because that note is done. That note now flips back into an accounts receivable. So only difference between these two entries right here is here they paid us and we got cash. Here they didn't pay us, and we're going to assume, unless we are told otherwise, that we are counting on getting this year's interest, last year's interest, and the principal until we know differently, and set that back up as an accounts receivable. Number 28. Valley Spa purchased $7,200 in plumbing components from Tubeman Company. Valley Spa Studios signed a 30-day 10% promissory note for $7,200. If the note is dishonored, what is the amount due on the note? Well, the amount due on the note would be the principal and the interest. So the interest is going to be $7,200 times 10% times 30 over 360, which is $60. Add the $60 to the $7,200 principal, and we get a total amount due of $7,260. Number 29. Valley Spa purchased $10,800 in plumbing components from Tubeman Company. Valley Spa Studios signed a 60-day 10% promissory note for $10,800. If the note is dishonored, what is the journal entry to record the dishonored note? Well, the entry would be, first of all, we've earned, this company has earned, that is, let's see, Tubeman has earned to get their principal back, which is the notes receivable for $10,980. They've also earned interest of $180, and that's based on $10,800 times looks like 60 days for 10%. That's $180 interest they've earned. And let's see what else here. We've these two together, the principal of 10,000. Actually, that's a typo there. That should be $10,800. That's a typo. So $10,800 there, that we get that off the books. Interest revenue of $180. The two together, we would normally get that back as a debit to cash for $10,980, but we're not going to get it back because they dishonored the note. Instead, we're going to put this back on the books as an accounts receivable and go try to collect it. Number 30. On July the 9th, Mifflin Company receives a $8,800 120-day 9% note from customer Peyton Summers on payment, or as payment on account. Compute the amount due at maturity for the note. Well, that'll be $8,800 times 0.09 times 120 over 360, which will equal the interest of $264 plus the principal of $8,800, or the maturity value of the note will be the sum of the interest plus the principal of $9,064. Number 31. On July the 9th, Mifflin Company receives a $10,400 90-day 8% note from customer Peyton Summers as payment on account. What entry should be made on July the 9th to record the receipt of the note? To record the receipt of the note, you set up a debit to notes receivable for $10,400 and get rid of the old accounts receivable for $10,400. So why would you ever turn an old accounts receivable into a note? And the reason is because you get this interest. You get interest. On the accounts receivable, you don't get any interest. Number 32. On July the 9th, Mifflin Company receives $9,000 90-day 6% note from customer Peyton Summers as payment on account. What entry should be made on the maturity date, assuming the maker pays in full? Well, if it pays in full, you're going to get the note principal and the note interest, and all that together is going to be a debit to cash of $91.35, a credit to interest revenue for $135, and also a credit to notes receivable, which we'd set up back up here. It's not the same amount, but when you set a note up here, then you get payment of it. That you had to get rid of that notes receivable. So if the numbers had been the same on this one as they are on this one, then we would have credited notes receivable for $10,400. But we have a different basic set of problems here. So we set the note for $9,000, so we get rid of the note for $9,000. Show the interest earned, and the sum of these two will be cash of $91.35. Number 33. On November the 19th, Nicholson Company receives a $19,800 60-day 10% note from a customer as payment on account. Payment on account. What adjusting entry should be made on December 31st? And the entry should be a debit to interest receivable for $231 and a credit to interest revenue for $231. And the way we got that is we take this $19,800, which is going to be this note amount, principal amount, times 10%, times 42 days. And the 42 days would be from November the 19th to December the 31st. So we're not getting any money here. We're just showing that this customer owes us the money to the tune of the 42 days at 10% interest, simple interest, which is $231. And number 34. On November the 1st, Oprim Company accepted a $10,900 90-day 17% note from a customer to settle an account, that being accounts receivable. What entry should be made on November the 1st to record the note acceptance? Well, we should put on the books the new note. So we're going to debit notes receivable for $10,900, and we're going to get rid of this old accounts receivable. So we're going to credit accounts receivable for $10,900. Again, why would we do this? We would do this because we're going to start earning 17% interest.